Hello, good morning, everyone. Welcome to our Phillip Securities Research Morning Call. Today, we will go through some few counter updates we have for you. The US market, we have a magnificent 7 counter updates for December and some result coming out from Wells Fargo, Bank of America. And then we also got for Singapore, we had Suntec and Fuxing China visit notes. And then we had technical analysis and the usual macro sector outlook for Singapore banking and risk monthly. Um, so this is our, as usual, the disclaimer. Please be noted that our presentation from the public sources, and please refer to your broker before making any investment decision. So without further ado, we'll start with the Phillip Singapore Weekly first. And over to you, Paul. Thank you.
Thanks. Thanks, Swami. Sorry for the change in order, just that I have to attend a business lunch later. So next slide. As usual, we'll just run through some of the key macro highlights in Singapore and the US. So for Singapore, some of the major highlights has been a lot of data coming out from the usual fourth quarter data coming out from URA. So we have a lot of residential data. So the key ones were like residential prices. So for residential prices, it was up only 0.6%, and on a 12-month basis, only up 3.3%. So this is actually positive. You'd be always worry when property price in Singapore rise double digit. So right now, it only up about 3.3%. So at least there's lower risk of intervention by the authorities. There was also data on new home sales. So for the year, for the month of December was slightly down, but for the whole year, we saw a big bounce, or 65% of new home sales, and to almost 11,000. So this is in line with the historical averages. The one other positive has been the residential inventory. So it's pretty lean. So the inventory, that means those with planned or unsold inventory, you're talking about 14,000 units. Of course, some of these haven't even been launched yet, but basically they received planning approval, yet to be launched. So this is quite lean. You're talking about only 1.4 years of inventory. And this is the lowest inventory of almost 4 years. So this will at least support the supply dynamics for upcoming new launches in Singapore. The inventory is below the average of almost 2.7 years. There was also data on the US inflation, the PCE inflation. Can we have the slides back? Yeah. Which is the PCE inflation. The PCE inflation, which the Fed uses to gauge rates, is about 2.8. I guess it's still November. At least it's coming with a lag, but it is still below the Fed forecast of 3%, which was expected in end December. So this is, I guess, generally a positive, and inflation in the US is so far still stable. Next slide. So move on to our usual tactical views. So every Monday we will send out in our morning note our weekly strategy highlights. So for this week, I guess the focus has been on gold. We just give you some of our current thoughts on gold. Just to dial back a bit, for gold, we cannot value it conventionally because they don't generate any cash flow. But there is three frameworks to at least price it. Of course, the number one is the opportunity cost method. So, because if you view gold like a zero coupon bond, when interest rates rise, it should lower the value of gold. Another framework to kind of price gold is money supply, or even using excess money supply to GDP to gold. The so-called fiat currency debasement framework. And the third one is, of course, the sanction and reserves model, which has been coming up by, you can read it in the IMF studies and even in some of the BIS comments. But in general, let me just give you the backdrop for gold. So the backdrop for gold is still positive. I think one way to think of it is that we'll show you some charts later, but if you expect a bear market in bonds or even a riot in bond prices, then of course you should expect flows going to gold. I think the rising fiscal situation in the US especially could trigger that. The second more evident has been the Chinese accumulation of gold to avoid confiscation, especially after Russian reserves were confiscated in April of 2022. We show you a chart later on that. So even after accumulating lots of gold is only around 10% of their foreign reserves, which is below the global average, about 18%. It's not on the chart, but if you look at money supply or M2 backed by gold, it's also very low. It's only like 1% for China compared to most countries about or as much as 5%. The recent flows into gold, especially from commentary by the U.S. administration in Davos, makes it even more concerning. Of course, there's worries over U.S. indebtedness, which has always been there, but I think we've seen recently Trump looking to raise the defense budget by almost 500 billion. Fed independence, I think we saw the commentary in Davos that he wants to replace a Fed official that will listen to him even more, I mean, in a nutshell. And rule of law, geopolitical alliances, I think we also saw his commentary in Davos. So when alliances are broken, then they might want to switch out of treasuries and move more into gold. So this recent phenomenon has been the one also causing a lot more flows into gold. And so that's why the backdrop remains positive. In terms of our view on residential property, our first point is that we think there's a limited risk of intervention. What we do think is that the authorities are using government land sales to increasing government land sales to manage prices rather than using by ABSD and so forth. For 2026, we think the pipeline is still positive. We are looking about 9,000 units. Most of it are in the OCR. So as you know, OCR usually have better take-up rates. So this would be positive for developers and also for real estate agents. The usual reasons why residential property is healthy is, of course, low interest rates. We're still getting HDB upgraders. The population is growing. There is a wealth transfer. Some estimates range from 8 to 10% of is parents buying for their kids. So there is that wealth transfer phenomena. Lifestyle choice, why they want to go to private. And of course, like we mentioned earlier, low inventory. The launch to watch is Newport Residence, which is in the CBD, and although it's freehold, but no, they're usually less amenities, less schools, and so it'll be interesting to see the launch, and it's probably an important launch for CDL. Some of the key events for this week is going to be the huge tech week of results, Meta, Microsoft, all there for you to see. There's also the FOMC interest rate meeting. The probability is that they're just going to keep the rates stable. We also have MAS monetary policy statement, but I don't think they're going to change anything. This week there won't be any corporate insights webinar, but next week we'll have some corporate insights. We actually have two Keppel REITs presenting on the 4th of Jan. This is open to anyone who wants to dial in. This Keppel Pacific Oak and also Keppel DC next week. Next slide. So I'll move on to some charts on gold. So the first one is if you look at the red line, so the red line is basically the gold price. And if you look at the blue line, which is the 30-year US Treasuries, in general, when interest rates come down, it should make gold more appealing. So we do see that, I think, but the recent phenomena of interest rates actually rising, which is the blue line, but gold price has also increased. One way to think of this is that if you think bond prices are going to drop because interest rates are going to climb even sharper, then of course the flows will go to gold because higher interest rates will cause bond prices to come down, obviously. The second chart on the right, you will notice the gold price actually rise in line with money supply, and there is quite a good correlation even visually when you see times when the blue line drops, actually gold price actually drops. So money supply has a good relationship with gold. We are using the M2 of some of the big countries, China, US. And we still think money supply will continue to rise, especially if you look at the recent loans growth number and of course with all the fiscal spending. So I think money supply is probably one of the best gauge of gold price, at least directionally. Next slide. If you look at the chart on the left, is just the blue line is basically when the Chinese central bank buy gold into their reserves. Of course, this is a voluntary disclosure, and they will and you do see the spike in gold since 2022. When, of course, not only the Chinese central banks, I think many central banks would view the seizure of or so-called weaponization of the US dollar to rather keep gold in their vaults rather than buy US treasuries which can be seized. And yeah, but this is no problem, purely a voluntary disclosure because it's up to them to disclose how much gold they have in their vaults. So they could be actually accumulating more. And of course, the one on the right is we do see now more and more central banks accumulating gold rather than US treasuries. Of course, a lot of it has been driven by the rise in the gold price. But if you look at this, they could also sell their gold holdings. But right now, you can see that gold, the red line is starting to displace treasuries as a reserve currency, as part of the international reserves. Next slide. Just two last slides for me. So the chart on the left is just confirmed government land sales. So in the past, the pre-pandemic, the government maybe released 4,600 units on the confirmed units, which is obviously not enough because demand is usually about 10 to 11,000 per year. Right now, you can see the government really aggressively boosting the amount of units on the confirmed list. We are talking about 9 to 10,000. First half of 26 confirmed list, it's about 4,005. Of course, if you add in everything, it's more than 10,000, but the confirmed list does show their willingness to raise supply. So this should help temper prices. The second last, the next slide is the unsold inventory. As you can see, inventory is about inventory is low, one of the lowest, and the red line is the inventory to sales, which is about 1.50 years, which is exceptionally low. Next slide. Okay, sorry. This is just some data from the commercial property released by URA. So you notice that rents are stable, growing about 1 to 2%, around 1%, 1 to 2%. And on the left-hand side, supply is very benign. So you look at retail, the amount of supply coming is only 1% per year, which is hardly anything. And for office is 2%, so which is a bit higher. But just to say that it's very supply benign. Yeah. Next slide. And this is just the usual chart of the cooling measures that we see. So if you look at the rate commentary in the raised ABSD in December in 2018, 2021, and 2023, each time they raise buyer stamp duty, you notice the price still continue rising. So I guess increasing supply is one way to temper kind of prices. And if you look at the cooling measure, usually when property price hit almost double digit, like 10.6 or 11%, that's when they start to intervene and start to raise the buyer stamp duties. So that's one thing that we watch. Right now, even after 2.5 years, if you look at the top post 2023 cooling measures, it's only up 11%. So actually, there's very little risk of the authorities intervening and kind of putting in cooling measures. Okay, thanks. That's it for me. Sorry, I have to rush off for another meeting. So thank you everyone for listening. Bye-bye.
Yeah, thanks, Paul. Yeah, so moving on to the Mag7 monthly, this is just covering the December month. We just go through the Mag7's performance. It recovered slightly by 0.2% compared to November. It was actually down by 2%. It slightly underperformed S&P 500, excuse me, which was up 0.3%, but it outperformed the Nasdaq, which was down. So we believe that investors have continued to take funds out of technology into the financials and industrials, driven by the profit taking, most likely at the year end, and also high valuation in the tech stocks. So December saw a bunch of mixed results. Nvidia was the biggest gainer after the US allowed sales of its H200 chips to China, whereas we saw AI infrastructure stocks like Google, Microsoft, and Amazon take a hit amid concerns about financing challenges for AI infrastructure. So the main support for the Mag7's performance in December was from the lower interest rates as well as the greater sovereign demand for AI. Okay, next slide, please. Yeah, so we're moving on to Tesla. The Tesla, there are only just two big news, I guess. The first one was the fourth quarter production numbers. So the deliveries were down by 16% year on year for the fourth quarter. It is as I predicted. So I did say, the third quarter was a bit of a was a bit of a weird one because it was up, and mainly due to the people rushing to buy a car before the EV tax credit fell off in end September, right? So in fourth quarter, I predicted that this would fall off, and indeed it did. It was actually a record quarterly year-on-year decline for the fourth quarter of 2025. We believe that this will continue to decline. The deliveries will continue to decline because now they have removed this $7,500 EV tax credit, and also the $5,000 cheaper car is actually it's still more expensive, right, than the normal standard car that they have, and you minus off a few features as well. The second point is that the China sales picked up slightly in December, but if you look at fourth quarter, it was actually a decline by 2%. Overall, BYD has still managed to grow much quicker. If you look at fourth quarter, they are actually up by 9% year-on-year for fourth quarter compared to Tesla's decline. So we still have, but you did see that Tesla share price rise mainly due to the optimism surrounding the company's promises, and more, I guess, specifically Elon Musk promises to turn electric vehicles into robo-taxis. But valuations have reached record high PEs of, we're looking around more than 300x due to these non-auto related promises like their full self-driving robo-taxi and also the Optimus robot. But we believe the headwinds are still very present because, essentially Tesla is just a car company. So they have a lot of competition from the Chinese EV makers. The tariffs are also still there. And also the removal of the EV tax credit will continue to hit and hurt their deliveries. And yeah, so we do maintain our sell recommendation with a target price of $220. That's all for Tesla. I'll now hand it over to, I think it's heading now for Apple. Yeah.
Thank you, Glenn. I'll continue with Apple. So the first news is, I guess, the biggest news in 2026 in tech is they're choosing Google's Gemini to run their next version of Siri. So they have actually struck a multi-year deal with Google to use Google Gemini model as the foundation of the next version of Siri, powering its future AI features and a more advanced personalized digital assistant later this year. The partnership marks a strategic shift in Apple's AI approach following evaluations of other models and aim to enhance Siri's capacity while maintaining Apple's focus on user privacy and on-device processing. The other news we noticed is they're actually the top in both the China and the global smartphone market in the quarter 4 of FY25. This is because they have very strong performance for their iPhone 17. The demand was much better than expected. So now the China, they're having a market share of around 22%, and globally they have a market share of around 20%. So you can see from the graph on the right side, the orange portion is actually Apple. You can tell they are in the leader position, but not very strongly. So the second runner compared to them, the difference is not so much. Overall, we've seen the deal that they have with Google Gemini is a very strategically sound, because Apple has been known to enter the AI race much later than their peers. So in order to catch up and build a very big language model, it will really require a very substantial and long timeline of investment. So partnering with Google is probably the smartest strategy they can do. So instead of trying to develop your own, why not just pair up with somebody who's already the leader position in this industry, right? And also they're also very smart because they're stressing that they're going to retain the control over the user experience and the broader ecosystem, because this is what Apple is known for their AI. They're always stressing that they're focusing on privacy first. So most of the processing is still designed to occur on device or within their own cloud rather than fully depending on Gemini. Right now, the function has not yet been rolled out, so we're maintaining a very close watch. Overall, we're still holding a reduced recommendation with a target price of $230. Moving on to the next company, which is Amazon. Next slide, please. So Amazon is actually planning to open a mega store in the suburb of Chicago. It's going to be the largest retail store to date in Chicago next year. And it's proposed to be 230,000 square foot offering groceries, household essentials, and general merchandise. It will operate as a public-facing retail outlet rather than a warehouse or a distributor center that they are known for, and will be comparable in size to other large format stores in the area. They're also planning to open additional shops across the US. And the second one is they're continuing their investment in AWS. So this is nothing new. They have recently launched the EU Sovereign Cloud, which is a new fully independent cloud infrastructure designed specifically for Europe and hosted entirely within Europe. And as part of the long-term commitment, they plan to invest 7.8 billion euro in Germany. And separately, they've also committed to invest 35 billion US dollar in the AI development in India by 2030. We think overall the company continues to reinforce both its retail and cloud modes through targeted long-term investment. The planning of their launch of the physical store may come to a surprise to some people, but honestly, this is something that they've been trying to do against the tariff measure and when the consumer spending environment is pretty flat. So what they're trying to do is they're trying to gain market share from those people who doesn't really purchase stuff online. They prefer to purchase in the physical store. So they've been trying to do things where they're selling more daily groceries online, and they're trying to stress more on same-day delivery. So they're trying to get a little bit market share. So opening this retail store is one more step in terms of them trying to fight the market share. At the same time, the continued investment in AWS shows that they're still seeing strong cloud demand coming in and is proactively trying to expand its capacity. So both we're seeing as very strategic move that further strengthens their long-term positioning. Overall, we have accumulated rating with a target price of $290 US. So that's all from me. I'll pass my time to, I think, Serena.
Hi, thanks, Helena. Good morning, everyone. I'm presenting Meta and Alphabet. Let's start with Meta first. So the company mentions that they will cut around like 30% of Metaverse budget and will shift the spending to focus on AI, including the variables. If you look at the chart at the bottom left, Metaverse, which is currently under the Reality Lab business segment, actually has been losing money since they started the vision. It accumulated over like $73 billion of losses since it started at the end of the 2020. At the same time, Meta also announced plan to acquire an AI agent startup called Manus for $2 billion. The company is under a subscription-based business model, and it actually reported to have around like 100 million annual recurring revenue 8 months after it launched. So moving forward, Meta will actually sell Manus services, but more importantly, it will integrate its specialty, which is AI agent, into Meta social media product. We actually think that the Metaverse budget reallocation and Manus acquisition, we think both of the decision are positive because the first one is that we think the budget cut is necessarily step to allow the resources to focus on core operation, which is digital ads, which will have a greater potential for returns if they done the execution in a very effective way. We also think the acquisition of Scale AI and Manus to actually provide a clearer roadmap for Meta AI monetization because Scale AI expertise in processing and structuring high quality data will actually support the training of LLM, which is Llama, which is currently lagging behind the competitors. And then Manus AI agent could be used to deploy across family of app, including WhatsApp, in order to enhance the ad ecosystem because they could analyze the user interaction and content trend. And after that, they will be able to predict the ad engagement so that they can optimize the ad placement automatically. And over the longer period, we do expect that the improved version of Llama will be strong enough to power Manus so that Meta can reduce the reliance on external LLM and at the same time to boost the operational efficiency as well. So for Meta, we have accumulate rating with target price of $770. Next slide, please. Thanks. So next for Alphabet, the company also announced the plan to acquire Intersect, which is a data center and energy infrastructure company for $4.75 billion. This is to support their growing energy demand while the company expand on the AI capabilities. Moving forward, there will also be a partnership with Apple to build the foundation models on Gemini as well. We actually think the Intersect acquisition, we view it quite positively because we think it will accelerate both data center and energy generation capacity. At the same time, it also helps Alphabet to explore some emerging technology in order to diversify the energy supply. Because currently we do see a rising average commercial electricity prices, especially in the states with a higher data center concentration, like Virginia and Ohio. The electricity prices actually up like 15 to 60%, 16% year-on-year basis because of the very high demand of energy to power this data center. So moving forward, we actually think that this demand push price hike are actually likely to increase Google operational costs. So that we think that moving forward, besides AI chips, it's also very strategic important to secure reliable power, given that, like I mentioned, the data center are very energy intensive. We also think that this acquisition will actually allows Alphabet to have more control over the power availability so that they can better mitigate the operational risk. And then for the multi-year collaboration with Apple, we do think that it presents a significant strategic opportunity for Alphabet because they power Apple next generation foundation model, and it will actually help to expand Gemini's footprint because of Apple very massive install device base. Yes, Apple will continue to guard the user privacy and actually keep their user data within their own infrastructure, but we do believe that this broader deployment combined with, of course, Apple will pay a licensing fee to Alphabet will actually continue to support the model development, and at the same time it will help to boost the Gemini market competitiveness against like competitors like OpenAI, ChatGPT. So this is why for Alphabet we have a buy rating with a target price of $340. That's all from me. I'll pass the time to Fahmi for Microsoft. Thanks very much.
For Microsoft, so in the previous quarter, they announced the dividends, and then they also make an announcement that they are going to price hike for their productivity suite. So dividend is something that they announce quarterly basis, but we think that we don't really talk about this often, so we're just gonna talk about it a little bit. So they announced a dividend of 91 cents per share for this quarter. If you take it annually, you will get $3 per year. So if you look at it, the dividend per share for last quarter, it grew 10% year over year. And then the same dividend also grew 10% and 11% a year ago and 2 years ago. So the growth amount is stagnant. And then there's also the dividend yield is at 0.8%, same as it was last year and 2 years ago. And probably this year, financial year of 2026, the dividend yield is going to remain at 0.8%. And then the next announcement is on the price hike on the productivity suite. So last time, the last increase was in 2022, which is the first price hike after they first announced the company product in 2011. So this price hike would probably affect both the commercial and the government client. And while this productivity suite is making up about 43% of the total revenue, so this price hike would positively affect, we think, the Microsoft revenue moving forward. As you see from the chart, this is the commercial booking. So we think that this price hike would eventually drive the Microsoft commercial booking, as it is already trending upward. We think it could go remain or higher because of this price hike. So for this price hike, there's higher percentage increase for the lower price plans. For example, for the Microsoft F1, which is Frontline Workers Plan, which is a simple plan, is having 33% in increment in price. So some of these products are used by, for example, like simple frontline workers like cashiers. And then there's also enterprise and basic plan for the productivity suite, which is a bit more complex and offer more application. For this kind of products, the price hikes is in the smaller amount of percentage growth, which is about 15%, 10%. But then again, we think in general, these price hikes, which would start since starting in June of 2026, we think it's going to positively affect Microsoft productivity suite. And for that, we maintain our accumulated recommendation for Microsoft at a lower target price of $540 from previously $550. So that is all from me. I will pass over to next presenter.
Thanks, Fahmi. I'll be presenting on NVIDIA's. So last month itself, US approved the sale of H200 chips to NVIDIA. So this is the second latest generation of GPU chips, and this is also the high-end version of the Hopper GPU chips. So on their condition for the sale of H200 chips, US government will take a 25% cut. As for China itself, I think last week itself, China mentioned that there's rumors that they are telling their tech firms to prepare orders for H200. Very recently, they actually banned H200 chips, but over the weekend, I think there's some news saying that they may allow. So if you can see on the chart on the right itself, the red color portion of the revenue represents China's percentage revenue, and then the dark blue color represents all other regions. So China makes up about 15 to 20% of NVIDIA's revenue historically. So if you take out 25% cut of sales, that will be about 8 to 12% potential revenue upside to NVIDIA if the H200 chips can be sold to China. For last month itself, for this month, start of January itself, NVIDIA also presented at CES 2026. So the key highlight is Vera Rubin. They mentioned that the next generation GPU is in full production and will ship by this year itself. And Vera Rubin also has 5 times greater inference performance as well as 10 times better throughput per watt compared to Blackwell. So why is this an important thing? Because the amount of AI tokens needed in terms of the workload is getting exponentially higher. So because of the energy constraints itself, the 10 times higher throughput per watt will put Vera Rubin at a very great advantage compared to its competitors, because this means that they are able to generate a greater number of tokens per unit of energy. And so this puts NVIDIA comparatively ahead. And also NVIDIA, because of its very strong CUDA software ecosystem, we do think that is able to bring in further revenue from for this next generation GPU. So all in all, even if China bans the sale of H200 chips, NVIDIA still has revenue visibility of about 380 billion for the next 5 quarters. So we estimate that to be about a 67% increase year on year on average. Yeah, so as you can see on the chart on the right, the dark blue color lines is still increasing, and hence we are optimistic on NVIDIA. We have an accumulate call and also a target price of 200. Yeah, next slide, please. Yeah, so overall we are overweight on the Mag7. As you can see, apart from Apple and Tesla, we have an accumulate or buy rating for the remaining Mag7 stocks. We do think that their performance is being supported by the Fed lowering their interest rates. And we also see some tailwinds going forward. For example, greater demand from AI from sovereign nations, as well as US government's AI action plan, which shows a greater emphasis on AI in the US, as well as more rate cuts expected in 2026. Yeah, so that's all for Mag7. Next slide. I'll be presenting Phillip on the ground for Intel. They released their 4th quarter results last week. For those who are not familiar, Intel Intel basically does they design the PC as well as data center CPU chips, and they also have a foundry business. So in terms of overall revenue itself, fourth quarter revenue was down 4% year on year, but it beat their guidance midpoint of 13.3 billion. So it actually beat guidance, but I think because of the huge amount of expectations that Intel would turn around very quickly, the stock actually sold down by more than 15% right after the results was released. And the fall in revenue year on year is because of supply constraints, both internally as well as with external suppliers. For example, as you can see in the table at the bottom right-hand corner, the client computing group, which is their PC segment, was down 7% year on year. We do think that this segment is still losing market share to AMD itself. Whereas the DCAI segment, which is the data center CPU segment, it is up 9%. So as you can see from these dynamics itself, they are allocating more resources from the PC side to the data center CPU side. Yeah, and that's also what Thunderbolt is trying to do to maintain the market share within the data center CPU segment. Whereas for their foundry segment, revenue is up 4% year on year. Because of an increased mix of EUV wafer mix. They mentioned that their 18A equipment yield has been improving, but it's not at industry leading standards yet. So it's not at like TSMC's 2 nanometer yields. And they have a very small segment of external foundry revenue from US government, as well as the deconsolidation of their previous minority stake. So we do think that their external government from US external revenue from US government will increase because after all, Intel is still a domestic US chip manufacturer. We do think that the US government having a stake in it will increase this external revenue for their foundry segment. In terms of Intel's guidance, they guided that first quarter revenue this year will decline because of the supply constraints and also because they have depleted their buffer inventory. Previously for fourth quarter 2025, they are able to use this buffer inventory, but right now it's being depleted already. However, the good thing is that management guided that factory network should improve supply constraints from second quarter onwards. So our outlook for Intel is that there will be short-term supply constraints within this 1 or 2 quarters. They are still losing market share in terms of CPU to AMD. However, we do think that the $5 billion deal with to design CPUs into NVIDIA's NVLink should help to offset this market share loss. Yeah, so that's overall our view on Intel. Yeah, so that's all from my end. I'll hand over the time to my colleagues. Thanks.
Hi everyone. So last week we initiated a new stock for the software company where we initiate Palantir. So for Palantir, we initiate Palantir at a buy initiation with the theme that there's more upside in the rapidly growing market. So Palantir is founded in 2003, going public 2020. Palantir is a leading US analytics software company where they take such a large amount of data set and then they have the large organization to integrate and make it like a software analysis large data set, which helps this organization to improve their decision making and also their operation. So the key customers include companies like the government agencies, which they have been doing business with for the last 20 years. For example, especially in the terrorism sector, intelligence agencies, and then there's also with the commercial sector, like enterprises in the various industries like oil, transportation, airline, and so many others. So just to make sense of it, of what they do, right? So this is like example of their products. So like I mentioned, what they do is basically they take such a large amount of data, like many other organizations would have data, right? And normally when it comes to big organization, they would have big amount of data. So they take this amount of data and then they build a software and then try to find a correlation between this data and build it into a mind map, which make it easier for the companies to make sense of it and operate based on this data. Like you can see from the chart, like a mind map, they make it like a correlation between this data. For example, when this particular data changes in one segment, what would happen to the others? And what's so good about it is that it's a real-time changes, meaning like if one variable changes, it would show to the others like what would happen next, and it would advise you on what should you do afterwards, for example, things like that. So it provide you, so basically it summarize the data and advise you what to do in the real times, like quickly what should you do. So yeah, this is used in many industries as well. And then so this is what in the middle sector is the ontology products. This is generally how it look. And on the right side, you got this they also integrate the artificial products, which is not new for them. They have been doing this for the last 2 to 3 years. You see from the chart on the right side that the mind map, right? If you show you click it and then probably ask some question on what to do, and then the artificial intelligence would advise you on what to do. Some of the artificial intelligence that they have Palantir have integrated into the products are from OpenAI and also from Anthropic. So basically, that's to summarize what they do. They take such a large amount of data and then make sense of it and then advise the clients on what you should do quickly in the real times, and you could get the more holistically what the business is doing and easy for decision maker to make sense of it. So this is their revenue breakdown. So the US government is making out the large portion of their revenue. And so the government, we expect which is the clients, the government, right? We expect it to grow 28%, but we do think that it's going to accelerate by this year to 43%. Same as this for the commercial, it's growing at 29%. We expect to grow 51% for this year. And then the US side is making the large chunk of their revenue, which is 70% of their total revenue. And you can see from the revenue chart on the left side, and there you can see that the total revenue is growing to 45% year-over-year in the recent quarter, and the US is making out the largest side of their revenue. So why we like the stock is first is because we think as there are more and more industries is taking their products, which is currently happening right now, it means that their commercial market is expanding as well. Their addressable market is growing as well. So there's more potential for them to grow. So for example, the ontology product I explained earlier is driving the 50% growth for their commercial growth. So this is led mostly by the US companies, which is the deals is doubling right now in the recent quarters. So means like just to show the demand is surging in the recent quarters. And then the growth is mostly fueled by the ontology visualization tools and the AIP product. And then there's also what's interesting about their commercial segment is what we call AIP Bootcamp, where Palantir have this hands-on program where customers can come to this bootcamp and build their own software based on their own data. So for a specific period of time, they could build their own software which tailored to their own industry and to their own companies, which they think that it would be helpful or not, and then which would shorten their sales cycle quickly. Customers go into a contract and make contract with Palantir. So even after they recently launched this AIP bootcamp since 2 years ago, the number of AIP bootcamp has grown considerably to 1,300, just to go to show that the rapid adoption of this product to the market. And that's for the commercial side. And then the other reason of why we like is the stable government revenue from the US deals. So when they do deals, they do it with the federal, state, local, and foreign government agencies. Like recently, we saw a large deal of contract with the US Defense Army, about 10 billion, which would have them to consolidate their service 10 times. And then there's also the UK products UK contract where it's been growing about contract of 1.5 billion US in there. Agency. And then the last one is that we like Palantir because of cash rich and minimal cash outflow. Cash equivalent for Palantir is about 8.4 billion, which is 80% of total assets. Yeah, cash flow has been growing at 3% year-over-year, and that has been lifting the CFO margin from 40% to 50%. They have low capex, so PPE purchase is only at 1% because they are a software company. And then they have been debt-free since 2022. And then this is for valuation. We initiate Palantir coverage at $200 US. We initiated at buy. So we believe that when it comes to Palantir valuation, it is better to you to compare to historical range, more appropriate than you compare to their peer comparison, because it's like an outlier. Because when you compare with peer comparison, you would always get a premium. So if you look on the left side, you will see the earnings has been growing considerably. The crude has been remaining, and the previous quarter has been growing at 100% plus in the same quarter. And you look on the right side, it's an old PE based on the consensus. Currently, because of the recent sell-off of AI, Palantir's PE has been less than this -1 standard deviation level. Yeah, because of that reason, we think we initiate Palantir by at $20 US. And we think that there's more potential upside for Palantir because currently their revenue is only 2% of their TAM of the total addressable market that they mentioned last time in the 2020 IPO. So we think that with the growing addressable market from the commercial side and as well as stable revenue from the government side, we think there's more potential for the Palantir to grow further. So there is a call for Palantir. We initiated buy at target price of $200 US. If possible, to the next presenter.
Thank you, Fahmi. I'll be presenting on Netflix, which released their earnings last week. Next slide, please. So both their first quarter revenue and PAMI were in line with the expectation. Sorry, next slide, please. Yeah, and it's actually beating guidance of their own company for both the fourth quarter and for the entire year. Their FY25 revenue and PAMI were at 100% and 99% of our FY25 estimate. Revenue rose 17% year on year. This is driven by multiple things. One is their membership is still growing very healthily. It grew 8% year on year. They've also been increasing prices over the past year, and also it's improving price mix, plan mix. That means more people are jumping from the cheaper price tier to the more expensive price tier. And also they're trying to scale their advertising revenue. Okay, so jumping straight to the positive and the negative. The positive is they're continuing having a very strong content pipeline, which is pushing both its top line and bottom line. So the past 2025, they have hit series like Stranger Things, Emily in Paris, and they have featured films like Frankenstein and A House of Diamond. And looking ahead for the upcoming titles in FY26, it includes Stranger Things, Avatar, and The Night Agent. They're also continuing to embrace live sport event like the NFL Christmas Game Day special that we just witnessed. And this year they're doing a World Baseball Classic in Japan. So this is sort of to add juice to their existing streaming business. Their membership grew 8% year on year. They've also guided that they have planned to increase their content spending by about 10% in FY26. Another thing is the highlight that they've been stressing over the past 6 months is the advertisement tier. The expansion is getting traction. So previously, they've guided they're going to double the ad revenue in FY25. So it turns out they ultimately delivered 2.5x growth and have guided a further doubling in FY26. So the ad-supported tiers, their viewing hours are also very comparable to the non-ad plans. So the engagement is good. And the CPMs are also at the upper end of the premium TV market. Netflix is increasingly prioritizing this tier, and in some cases, they actually automatically migrate subscribers to the ad-supported plan. So that shows the high monetizing potential because for them, even if you subscribe a cheaper ad tier plan, and just because you're constantly watching, so the ad revenue that you generate from a constant viewer can actually exceed the price that you get from them booking a higher price tier instead. So we view continued monetization of the ad-supported tier as a key long-term growth driver. Right now, it's still a very small portion, only 3% of the total revenue, but they're definitely trying to expand it in the future. And then moving on to the negative, so this is probably one of the reasons why the share price has not been doing well for quite some time, is because of the uncertainty that they're trying to acquire the Warner Brothers. So the proposed deal does added execution and financial uncertainty. And Netflix, they want to win the deal so bad, they actually recently sweetened the offer. Now they're willing to pay all cash. So that means they're taking on an additional 8.2 billion of debt in order to fast track the transaction. So this raised a lot of concern about how they're going to integrate the two big companies. What are the regulatory problems that they're going to have? And near term, do they have the ability to have content synergies when they combine the two companies together? But that said, even though they're taking out more debt, so that definitely complicates their debt position, but it's not unmanageable because if you take a look at their free cash flow last year, just 1 year alone, they're generating 10 billion US dollar. So they definitely have the financial structure to pay back the loan. And another thing is the engagement per viewer has declined. So they did mention that viewing hours increased for both the first half and the second half, increased by 1% and 2% year on year. But if you bear in mind, new membership is actually growing at 8% year on year. So that implies the engagement on a per viewer basis actually decreased. And this, they also explain why. They say it was driven by a reduction in the licensed second run content. So that is because in 2023 and 2024, there was a lot of production strikes. So there's not a lot of new content coming out. So Netflix actually decided they're going to increase the spend they're going to have on the licensed second run content. And now because they have so many new production coming up, they've decided that they can take away some of the licensed shows. Like personally, I was watching Friends on Netflix and now it's been canceled. So because of that, they're decreasing a lot of viewings on that. And we feel engagement is something that Netflix has to be working on because this is a relative weakness for them, not to compare with streaming companies, but to compare with other competitors like YouTube, because the time spent per user on YouTube is structurally much higher. It takes about 13% of US viewing time, where Netflix is only 8%. And this is a key risk because engagement is directly linked to monetization, particularly if Netflix is increasingly trying to rely on its advertising growth, where sustained viewing hours are crucial to ad inventory fill rates and CPM. Moving on to guidance, they have guided the first quarter of FY26, the revenue to grow by 15%, and also they've expected operating margin to increase 400 BPS. And for the entire year, they expect revenue to grow about 12 to 14%. So it's relative slowdown compared to this year, but this is more or less within consensus of the analysts, and they've also guided a small margin expansion. So I believe overall Netflix is well positioned, both structurally and financially, because we have this ongoing trend of people switching from live television to streaming, and also they have the ability to deliver a very strong content slate. So for the streaming company, content is king, and they're going to be able to keep coming up with a very strong content while maintaining profitability. So that's very remarkable. And another thing is they're trying to expand on their advertising, and they're being very successfully doing so. So even though the Warner Brothers deal introduced near-term uncertainty, but we have to bear in mind that they're approaching this transaction from a position of strength rather than necessity, because it's not like the company is failing. It's not that they need the Warner Brothers deal to make sure that they can survive. It's more that they're trying to do it because they've been doing so well in their streaming that they're thinking that they need to expand into other areas, into the studios. So if successful, the deal will significantly narrow the IP gap with Netflix and Disney, and that will position Netflix as the leading screen-based IP owner, which further drives upside for their ARPU and monetization. So overall, we upgrade our recommendation from sell to accumulate, but this is mainly because of the recent share price movement. And now we have a hard target price of 100 US dollar. So we do think that Netflix continue to dominate clear leadership in the streaming space, and they have very strong pricing power. So volatility is expected, but in the long term, we think they're still very well positioned for long-term growth. So that's all from me. I'll pass my time to my colleagues.
Yeah, thanks, Helena. Yeah, so we'll be covering the two US banks, Wells Fargo. We'll start off first with Wells Fargo. Yeah, the main earnings for fourth quarter grew 6% year on year, and the full year earnings came in slightly below estimates at 96% of our forecast. The key highlights is that, the net interest income has continued to grow. So we saw it inch up by 4%, mainly from higher loan as well as investment security balances, fixed rate asset repricing, and also better markets business. But the non-interest income, is the one that really supported earnings, and it came in from the investment advisory, brokerage, as well as card fees. So we did see investment banking actually disappoint. It dipped by 1%, but if you look at the whole non-interest income, actually grew 5% and accounted for 42% of total revenue. Another positive that we have seen that helped also push up earnings was the provisions falling by 5% year-on-year. This was mainly from net charge-offs declining by 14% from lower commercial real estate net loan charge-offs, and the total net charge-off ratio also improved by 10 basis points year-on-year to 0.43%. The biggest negative, and I guess the only negative, was that the severance expense has hampered the earnings momentum. So there was severance expense of 612 million, which came in higher than expected, and this pushed up the total OpEx. And if you had removed this, earnings would have actually risen by quite a bit more. For their guidance into 2026, they're guided for net interest income of 50 billion, which is equivalent to around a 5% year-on-year increase. This will be driven by growth in the balance sheet, so loans and deposits, and also continued fixed asset repricing. And for guidance, for the expense-wise, it's at 55.7 billion, so that's an increase of 2% year-on-year. So they're expecting lower severance expense, which would really help, and as well as higher revenue-related expense in the wealth and investment management businesses. So if you look at these two figures that they've given, the NII growth is actually much faster at 5% than the expense growth of 2%. So we do have an accumulate call with a higher target price of $98, and we expect that the lifting of the asset cap will allow the bank to continue to grow. So they have really surpassed that 2 billion cap that they had. Total assets for FY25 is 2.15 billion, and they will be continuing to grow their loan and deposit book. However, we do see some headwinds that will come from macroeconomic factors, and this will slightly impact their non-interest income, which still makes a very large part of their business, around 40+%, and it might impact their investment banking and trading activities. So that's for Wells Fargo. Now let's move on to the next bank that we have, which is Bank of America. So Bank of America, it was very positive. We saw growth across the board. Their fourth quarter PATMI rose by 12% year-on-year, but it did come in slightly below our estimates in full year FY25 earnings at 95% of our forecast. What missed estimates for us was the lower than expected market making income as well as higher expenses. The earnings growth came from higher net interest income and investment and brokerage fees as well as lower provisions, which are basically the three main positives that we have. So net interest income rose by 10% year-on-year, which is the highest among the three banks that we cover, from global markets activity, rising fixed rate asset repricing, and higher deposit loan balances. So the net interest yield did rise because the decline in the interest-bearing liabilities rate was faster than the decline in earnings assets, so yield. So we saw that overlap, and then that's why the net yield continued to rise. Non-interest income has also continued to provide further support, mainly from asset management fees, and their global markets revenue also rose 10% year-on-year. But again, similar to Wells Fargo, their investment banking fees did disappoint slightly. It was only up by 1% year-on-year. The last positive is that the provisions have continued to decline. So net charge-offs fell by 12%, from both consumer and commercial net charge-offs falling. And similar, we saw lower credit card losses and also the commercial real estate office losses declining. As for the outlook, for the guidance, they are expecting the net interest income for FY26 to grow by 5 to 7%, and the growth for first quarter for net interest income will be 7%. So for expenses, they're expected to grow slower, at growth of only 4% year-on-year for the first quarter, but we believe that this will continue for the rest of the year. So we are expecting around a 4% growth for full year 2026. We do maintain and accumulate with a higher target price of $60. We believe that the growth drivers for Bank of America will come from the higher net interest income, continued growth in their wealth management fees, higher global markets revenue, as well as a slower pace of expense growth. Yeah, so that's for Bank of America. Yeah, moving on to so we're going on to the banking monthly. For interest rates rise, not much change in the story, right? It just continued to fall. It's reached the lowest in 41 months, sorry, for the 3-month SORA. Compared to the fourth quarter average, it was 8 basis points lower. For Hong Kong interest rates, it also continued to fall. They fell for the second consecutive month by 29 basis points month-on-month to 3.04%. Now moving on to the next slide. Yep. So one of the benefits of having lower interest rates is that loans growth will inch up, and we have will recover, and it has recovered quite well. It was up 6.6% year-on-year in November. A bit higher than the last month's growth of 6.5%. Year-to-date loans were up by 5.8%. So we saw growth across business and consumer loans. The building and construction segment, which is the single largest business segment, was up by 1.7%. Yeah, next slide, please. Yeah, so for the deposits and balances, it has continued to grow as well. We saw the total deposits and balances growing by 7% year-on-year. And more importantly, the current account and savings account, or CASA ratio, rose to 19.7%. And the CASA also grew by the total CASA grew by 16% year-on-year. And it's very important for the banks because this represents the lowest cost of funds for the banks. So the higher the CASA ratio, the higher the CASA, it means that the cost of funds will be lower. And we expect that the CASA ratio will continue to rise as the higher interest fixed deposits that you have gotten maybe 1 or 2 years ago continue to mature and funds are shifted back to their CASA. And it stays there. Yeah, moving on to the next slide, we'll be looking at the SGX statistics. So the SDAV rose by 23% in December, and the DDAV rose by 17%. For the VIX, which is the market volatility index that we use, it was around 15.6, so lower than the previous month's 19.8. And for the top 4 equity index futures, it inched up by 3%, mainly due to an increase from the FTSE China A50 index futures volumes. Moving on to the next slide, we're looking at the Singapore Bank's performance for December. Yeah, the share price of the 3 local banks rose by 4.4% in December, mainly supported by the continued strong performance from OCBC due to their strong set of results that they released, and also a lot of potential in higher dividends from their excess capital ratios. So we have some quick earnings preview for the 3 local banks. DBS is on 9 February, UOB on 24 Feb, and OCBC likely on 25th Feb. So for DBS, we estimate 4Q PATMI of around 2.97 billion, so an increase of around 13%. For UOB, around 1.49 billion, so we expect a slight dip of 2%. And for OCBC, it's around 1.92 billion, so around 14% increase. We expect that NIM compression will likely continue into the fourth quarter, but the net interest income decline will slow down as we have seen the loans growth recover very strongly, and the fee income will be the main growth driver and some potential upside to earnings if provisions are returned back. Yeah, so I think someone also asked in the Q&A, the target price for UOB is $30. We have actually raised the target price for UOB to $36.70, and also our recommendation for all 3 banks are now neutral, or you can also see as a whole. Yeah, as we await a bit more clarity on their earnings in the fourth quarter. Yeah. So next slide, please. Yeah, so that's all for the banking monthly. We do maintain neutral, and all our recommendations for the banks are also now neutral. We believe that the continued decline in the interest rates in both Singapore and Hong Kong, they will continue to affect the bank's net interest margins, which will also, impact the net interest income and earnings. But that, the higher CASA ratio and deposit rate cuts will help to ease this margin compression, and also help to pull up net interest income slightly. Yeah, that's all I have for the banking sector. I'll now hand it over to I think it's Darren for the REITs. Yeah, thanks.
Yeah, thanks, Glenn. Yeah, I'll run through Suntec REIT's results. So their full year results released last Friday. Yeah, so the results, their second half DPU of 3.88 cents was definitely beat our expectations. The full year DPU came in about 104% of our estimates, mainly because of very strong performance in Singapore, as well as the almost 13% decline year on year in financing costs. So that's a very significant drop in financing costs. So that was why the DPU beat our expectations. Yeah, so generally gross revenue is up 1.7 mainly because of the strong Singapore portfolio and as well as the JV properties as well, the office, BFC and ORQ. Yeah, so for the positives, the Singapore office and retail segment continues to have very strong positive rent reversion. So office at 9.6%, retail at 15.3%. So the Suntec City Mall had 16.3% positive rent reversion. Occupancy also for the Singapore properties are very high. The office at 98.2 and the retail's Suntec over 99%. Yeah, and another positive is also the very sharp decline in financing costs. Like year on year, the average cost of debt declined 35 basis points. So now it's at 3.71. So going forward, we expect the all-in cost of debt to remain to kind of remain around similar levels or decline slightly because they have about 100 million of loans that they have due for refinancing. So we expect some savings from that, as well as the perps that they're due for refinancing, 150 million at 4.25. So when they refinance that, the rate will definitely be lower than 4%. So they'll have some interest savings there. But these will be offset by the fact that they are AUD loans. They enter into some swaps in 2020 that are expiring this year. And those rates are at 0.4, 0.5%. So when those swaps expire, then of course the interest rate for that will increase. So overall, we expect the cost of debt to remain or just improve slightly because of the AUD at very low rates, the swap rates that are expiring. Yeah, and gearing also improved year on year to 41.5%. They're still looking to divest the Suntec City Strata office. It was slow in 2025. They're targeting 100 million in 2026 annually, or rather. Yeah, and for portfolio valuations, Singapore was anchor up 0.9%. Overall, it's up 0.7%. So for Australia and UK, we saw some slight cap rate expansion, like 10 basis points to 40 basis points. But the strong operating performance in UK, especially the Nova properties, that resulted in the increase in valuation. Yeah, but for the overseas property, 55 Curry Street remains weak. Occupancy, it did increase to 66% quarter on quarter from about 50%, but it's still it's only 66%. And in Australia, so the headline rent looks very good, almost 26%, but the effective rent is only positive 1%. But that's mainly from the fact that in Australia, like Melbourne and Adelaide, the tenant incentives are still 40 to 50%. So that's why the effective rents is only 1%. And in the UK, the Minister building is still only 85.4% occupied. So they are trying to get the occupancy up for these weaker properties. So for Suntec REIT, the overseas portfolio remains a drag, but is anchored by some of the stronger Australian properties. So they do have some stable ones like 177, and all these are at full occupancy. Yeah, so for the outlook, they are still targeting 100 million investments for Suntec City Strata office sales. And for this year, they're also looking to kind of reposition or rather their assets. So they're looking to divest possibly one or two overseas assets to maintain gearing at 40%. And for the acquisition of the REIT manager, is still not complete yet. We think it will completed over the next couple of months. So that's a positive, as the new sponsor likely can have some new pipeline of assets for Suntec REIT in Singapore. Yeah, so for the outlook of rental reversions in Singapore, we still expect to remain resilient, at least 5% for office and looking at about 10% for retail, supported by mainly limited supply and still strong demand. Yeah, so With that, we maintain our accumulate call with a higher target price as we roll forward our forecast to 2026 numbers, as well as a higher DPU from better performance and lower interest rates. Yeah, so the there's a typo there. FY26 dividend yield is 5.2% with a price to NAV of 0.72 times. So it's still trading below book. Yeah, next slide, please. Now we move on to our REIT monthly. So generally, we expect cheaper funding costs to drive DPU growth for 2026 and in 2025 full year 2025 results included. So this is just a share price performance. We see a REIT index up 11.3% in 2025, and yeah, basically the just 1 month performance, the commercials down 7.8%, but that's because of capital REITs. They are so-called dilutive acquisition of another one to stay in MBFC Tower 3. So that's why the share price is down, but generally it's relatively flat share price in December. Yeah, next slide, please. Yeah, so moving on to our dividend yield spread. It's the dividend yield spread. Now you can see it as how much investors are being compensated by investing in REITs as so-called the risky asset over the risk-free rate or like a proxy to your fixed deposit. So the yield spread has now fallen, but that's mainly because the 10-year government bond yield has risen to about 2.1, 2.2%. So as a result, the spread has narrowed. But going forward, we do expect with absolute DPU growth, like I mentioned previously, the forward dividend yield will increase assuming share price remain constant, and the 10-year yield assuming stable. Yeah, the dividend yield spread will definitely will likely to increase. So we think it is attractive at these levels to invest in S-REITs as well, as you're getting the like 3.3% upside in yield over the so-called the risk-free rate. And yeah, all this is supported by the fact that the 3-month SORA, which a lot of the REITs use as their base rates for Singapore loans, is now at 1.19, declined almost 200 basis points year on year. So that's significant interest cost savings. Yeah, next slide, please. Yeah, next we move on to a forward dividend yield, 5.4% is expected to increase, like I mentioned, and the price to NAV now is around 1 times. So it's around the historical average. We expect at these levels is still attractive because we do think that the valuations of property valuations will likely to increase, especially in Singapore. So as the NAV increases, then there is room for the price NAV to still improve. Yeah, next slide, please. Yeah, so we move on to some of the subsector monthly indicators. So for retail sales, it's still very strong. November up 5.8%. We think going forward, retail sales likely will remain very strong because of things like population growth and the continued government support measures. Like there is still about 1 billion worth in government kind of government support measures like a CDC voucher and unused SG60 vouchers that's yet to be claimed. So the expiry date is end of this year. So there is still about 1 billion of those, as well as the fact that there is a limited incoming supply as well, and occupancy cost still generally is either stable and or roughly around pre-COVID levels or slightly below pre-COVID levels and stable year on year as well. Yeah, next slide, please. Yeah, for hospitality, visitor arrivals are still improving year on year, but it's still shy of pre-COVID levels. So we think the full year 2025 number will likely fall short of pre-COVID. We think year on year in 2026, it is likely that international visitor arrivals will improve year on year. Not sure whether we will hit pre-COVID levels by this year, but at least we are looking at 95% of pre-COVID levels. But another a good thing to know is that tourist receipts are higher than pre-COVID levels already, despite the lower visitor arrival. So that will benefit the retail sales, like I mentioned previously. And for 2026, our outlook generally we expect the hotel RevPAR to remain rather flat. So hotel occupancy we expect it to remain to improve slightly, but that is at a cost of possibly average daily room rates, as a lot of these hotels they adjust their room rates to kind of try to increase the occupancy. So ADRs might, in our view, might be flat or might decline slightly. Yeah, so that's for hospitality. Next slide, please. Yeah, so this is our REIT coverage. Yep. I'll now hand over time to the next presenter. Thanks. Yeah. Hand over to Serena. Thank
Thanks, Darren. Hi, everyone. I'll provide an update on Fuxing China Group Limited. Please note that we do not actually cover this company, but we actually had a site visit 2 weeks ago in Jinjiang, China. Next slide, please. So for those who are unfamiliar with the company, it is a China-based SGX listed manufacturing company. They specialize in zipper. Fuxing is the fourth largest zipper manufacturer globally by sales value and the third largest in China. The company focus on three core segments. The first one is zipper, which is around 56% of the total revenue. It covers the manufacturing and sales of zipper that you can see in clothes, luggages, and also outdoor gear. And these products are marketed under a brand called 3F. And the second one is value-added processing, which is around 14% of the revenue. It includes dyeing and electroplating. And the third one will be trading of textile, which is around 30% of the revenue, such as nylon yarn, fabric, and also rubber threads. Most of the sales currently came from mainland China, and they work with well-known brands such as Anta and Li-Ning. Under the second generation leadership, Fuxing currently has try to modernize the production facility through the automation. So moving forward to the short-term catalyst, the company has officially canceled a secondary listing plan on Nasdaq because of the market condition. So that the decision would actually eliminate the IPO related cash outflow and streamlines the company financial reporting. Because it will remove the potential obligation associated with this listing. And secondly, the divestment of the loss-making subsidiary called Jinjiang has been completed. This business actually has been quite a loss-making subsidiary because the maintenance costs for the very aging machine are high. And moving forward, the company do expect the government to impose a stricter environmental regulation on dye yarn manufacturing. So all of these factors actually pressure the group's cost and margin. So we actually do think that the divestment after the divestment, the overall profit and margin should be improved. Next slide, please. Thanks. For long-term catalysts, moving forward, the company do expect to expand the customer base by focusing on mid-tier brands, and they will also try to be more focus on volume through a low price strategy compared to the competitors, which most of them are actually focused on a high-end luxury brands. So in terms of pricing, Fuxing has around 30% pricing advantage compared to YKK. This is actually a Japanese base. It's also the largest zipper manufacturer in the world. And Fuxing has a very extensive patents portfolio as well. If you look at the picture on the top left, yeah, this is one of the most popular zipper types. They actually had a patent. It's actually called zero gravity zipper because it's extremely lightweight. So that they can be used on sport clothes, and currently it contributes around 5% of Fuxing zipper revenue. To moving forward, in order to enhance the margin, the management they will also prioritize direct to brand sales. Because before that they have a middle person that to actually liaise with all the sales. They want to focus on direct to brand so that they can reduce the reliance on this intermediary, because it will allows them to have more solid client relationship, and at the same time it will help to boost this 3F brand recognition as well. And then next, because of the automation, Fuxing also managed to boost the production capacity and efficiency. Currently, the machinery is operating around like 80% of the utilization, so that the company is capable of handling new orders moving forward without having to have additional facility investment. And so that moving forward, there will be potentially lower CapEx, because the transition to automate production line is almost complete. Is most of them are actually completed. So one of the example that you can see is the picture in the middle, and they actually use it to spray the zipper with the color depending on the client's demand by labor before that. So that so that you will be able, there are actually people that are standing there and spraying the zipper manually, but now that because of the automation, they actually started to utilize like robotic arm to actually complete, especially for a bigger order. So yeah, I think that's all from me. I'll pass the time to Zane for technicals. Thanks very much.
Thanks, Serena. Good morning, everyone. I'll move on to the technicals. Yeah, so first up, taking a look at the S&P 500. Last week was quite sideways despite the gap down we saw on Tuesday. It ended up down about 0.3% for the week. So in terms of the charts, currently the price is below this short-term trend line that's formed since mid-November. And but it's currently still holding the key 50 to 100-day SMA supports. So it's the green line is the 50-day SMA, and then the blue line you see in the chart is the 100 SMAs. So overall, during this sideways consolidation, price is still holding above these two a bit longer term support. So I think it's still okay in terms of the uptrend. So I think for now, we're likely to see a bit of a continued sideways consolidation, as there's still quite a bit of resistance at the 6,960 to 7,000 area. And then as for supports, I think we're likely to hold last week's swing low, which is 6,790, and then to about 6,900, which was the two swing lows that we saw on Thursday as well as Friday. Yeah, so that's in terms of the broad market. Next slide. Yeah, so this one is just I will just go through what's the current performance of our technical calls issued the last week. So we had a buy stop call for Nordic. It's currently in progress, up about 3.2%. And then we had a buy on Riverstone. It's currently flat as of Friday's close. Yeah, so that's all from me. I think we can go to Q&A next. Thanks.
Thanks, Zane. Let me just take some of the questions first. Yeah. Yeah, so someone asked, what's the views on Elon Musk's visions that was articulated at Davos. So, it's I don't think he said he's his usual self, right? He was like gives this kind of like big visions. Where I think the main one was he was talking about how robotics will take over the labor problem, the labor issue that they're having. Yeah, and where robots like his Tesla's, his Optimus robot will outnumber and also replace human labor. But and he also said, I think he gave a timeline of end 2027 where it will be out into public. I think that's very, very, very optimistic. I highly doubt it will come out in 2027, maybe 2030 if you're even lucky. The other things that are maybe not as far-fetched would be the electricity generation ceiling, right? He's saying that it could be powered by solar energy, the whole of the US. Also a bit more far-fetched, sorry. And the other one was the AI super intelligence, where he's saying that it could be smarter than human, and also, it could be smarter than all of humanity combined. Yeah, so, and also the last one I think he said was more specifically to Tesla would be him trying to get approval for the full self-driving or supervised full self-driving in Europe and China. I think that's more to quell all the worries that investors have about growth limits that he's having currently in the US and in North America. right? So it will be quite hard whether you can even get this in a few months' time. Yeah, so he's really having a lot of difficulties getting the robo-taxi in US. Yeah. So I think a lot of his things are really a bit more far-fetched. So it's nothing unlike him, right? So quite normal for him to come up with all these kind of ideas and promises. Yeah. So I wouldn't put much you know I just wouldn't I would take everything he says with a pinch of salt. Yeah, that's what I'm saying. Okay, yeah, there's one for big tech earnings this week. Yeah, I'll get for Tesla, I think you know my stand is that I don't think it'll be very positive. We saw deliveries decline, very likely earnings will decline by just as much or even more, because their margins are now being more compressed. Yeah, I'll get the rest of my team will talk about the stocks that they cover. There's quite a few on the banks I think I saw that came in. Hold on, let me try to find it. Yeah, someone asked any thoughts on the key drivers for the sudden surge on the UOB stock to a new all-time high. Perhaps UOB price dropped before in last quarter and was overdone after a huge provision, which investors now felt was overly conservative and expect better days and better earnings ahead. Yeah, quite true. I think Ian, whatever you said is quite spot on. Yeah, so the provisions did come as a big shock, right? Which is why we saw their share price pull back quite a bit. And I mean, now that it has gone back up, it's just recovering back to how much it has lost. You look at the year to date for at least 2025, right? It cannot compare to the growth that DBS and OCBC have seen, right? So we are really hoping for better earnings ahead and better days ahead. If they don't have any more of this unforeseen or unexpected provisions in such a huge amount as well that come in. Yeah. So we believe that next quarter will be better, I believe, in the fourth quarter when they release the results. But the full year next year is when we will see whether or not they really did provision enough. For provision of a severance expense, this is probably one-off, like UOB, and could expect much better earnings going forward. I think you're talking about Wells Fargo. Sorry, I think you're talking about Bank of America, right? No, sorry, Wells Fargo. Yeah, Wells Fargo. I think you're talking about Wells Fargo. Yes, the 615 million. Yeah, it's probably a one-off, which is why we are a bit more positive because the other lines of business are doing quite well, right? You look at the biggest one, which would be the asset cap lift, right? That would allow them to grow their loans and deposits much faster. So yeah, if you want to compare it to UOB, it's very different because UOB's main business, right, their net interest income is not growing very well. Their fee income disappointed a lot, right? So that's the biggest, I guess, a negative for UOB's last results in the third quarter, that their fee income did very poorly against DBS and OCBC. Whereas for Wells Fargo, the only thing pulling them back, or at least not allowing them to grow very fast, is the severance expense. And that's something that they can control, right? And they really gave a lot of good indication that, or guidance that next year or this year, 2026, will be a better year in terms of that expense growth. Yeah, some ask, by not covering Citi, does it mean not as favorable? No, yeah, we just don't cover it because yeah, we just don't have coverage on it. Not that it's not better or worse. So for Singapore banks, why are CASA going up when interests are coming down? Is it not better to invest in the bank stocks instead for 5% yield? Yeah, but when people keep CASA, it means they want liquid assets, they want cash, right? So CASA is the most liquid you can have. And a lot of the capital that's coming in, it's maybe not from Singapore, it could be from overseas as well, because they see Singapore as a safe haven, right? And it's a bit like a snowball effect, right? When the capital come in, right, then the interest rates also decline. So then if more capital comes in, then the interest rates will continue to decline as well, which is why we keep seeing this, and it's a bit of a snowball effect, which is what I'm saying. So when you invest in a bank stock, for the 5% yield, yeah, it's definitely very attractive, but not everybody would want to park their money into stock, right, and to get that yield. And it's not like you will be getting your dividends credited to you every month, right, or every day, daily kind of credit. So, and it's also there's risk, right, when you invest in a bank stock, right, that the share price will fluctuate. Don't, you also add in all the brokerage fees and everything. Yeah, so there's many reasons why CASA is going up, that people just want to park their money into a safe haven, right? Especially, Singapore being such a safe country and financial hub. So that's why they're putting their money here, and which is why CASA is going up. And then you also see the interest rates going down. Yeah, I guess they're okay with not earning, earning that base interest. Yeah, OCBC, what is the dividend for this year? When you refer to dividend, I assume you're referring to for 2026, but I'll give you both numbers. So for dividend per share for 2025, full year, we're expecting $1.02. And for 2026, we're expecting $1.14. So $1.14 is inclusive. We are expecting and assuming that they will continue with their capital returns of the 10%, right? So that's based on a dividend payout ratio of 63%, with which we get this $1.14. So if you can see that if they don't give this 10% capital returns dividend, right, you can see their dividend per share might actually decline at an absolute level, where we see it, it might even be the same amount as 2025. So yeah, a lot of it is banking on the new CEO actually, announcing a continued capital return plan. Right, DBS has already done it, right? And OCBC with such a huge amount of excess capital and not much news on acquisitions or spending this money that they have hoarded away or stored away, sorry. Yeah, so we are expecting that they will announce something. Yeah. So I got it right. Wells Fargo, yeah. Yeah. So I think there's one more question. Someone asked, I couldn't find it, but about the market share of Waymo. Yeah. So Waymo is actually owned by Alphabet, right? So they are by Google. So they're really the only ones providing the self-driving rides, right? The fully autonomous rides in the US. So I think the question was asking to compare against Tesla and Uber. Uber doesn't do it themselves. They're just a platform, right? They're just a platform where you can book the ride, right? So that you can't compare Uber to them. And Tesla doesn't even do it commercially now. They're just doing test runs in certain areas, and it's not even fully self-driving, right? You will have some human either at the back or at the front sitting there to check on the car, right? To make sure that it's still safe. So they're still in the trial run, test run. So there's no comparison in terms of trying to see Waymo against Tesla. Yeah. So Tesla is trying to be a disruptor to Waymo. Yeah, so someone's here asking, do you expect some same playbook of big cap banks cutting jobs just before earnings results to account for provision and then paint a more optimistic picture in future earnings, boosting bank stock prices? Yeah, I don't think so. No, I think, yeah, even if they do cut jobs, yeah, I really doubt it. I don't think that this is the same playbook for big cap banks. I mean, I think this is more for the US, right? Singapore, they don't really do this. Just cut jobs and then provision for it. Yeah. Yeah, it happened at Citigroup because it happened at Citigroup. Good point, because they did a restructuring, right? They did a massive restructuring, which actually hit them quite hard, right? We saw their share price tank, and then they had a lot of flack because of the way that they did the restructuring. Whereas you see Wells Fargo, they are doing a less severe, less aggressive style of restructuring. Yeah, I guess it's just to change things up, lah. But look at JP Morgan and Bank of America. They're not doing a similar thing. They also depends on the board of directors as well. Okay, I think that's all I have. Better leave some time for the rest of my colleagues. Yeah, hand it over to the rest. Thanks.
Thanks, Glenn. I'll take over some. Why is Apple share price performing poorly recently? So the recent news that we see from Apple, everything is actually pretty positive. Them collaborating with Gemini and them being the top company in terms of market share in both China and the global market. But I guess fundamentally, because the smartphone market right now, people are focusing on whether you're going to be able to come up with the cutting edge AI features, and they're really much lacking compared to all the big tech companies. All the big tech companies, they're growing their earnings at like 20+% year on year each quarter. But compared to Apple, Apple's growth is pretty much flat. And that doesn't really justify because their forward PE ratio is still very high at 30x plus. So that is just very hard for them to justify. I guess right now, yes, whether they're going to collaborate with Google Gemini, that's definitely going to be a plus on their AI sector. But I guess right now, because Apple, they have announced their Apple Intelligence previously, then when they roll out, there's a lot of mistakes, there's a lot of the same. So the market doesn't really have confidence in Apple's AI anymore. So they're more in a show me stage. So if you want us to believe in you, you better come up with some concrete result for us to believe in you. So personally, yes, them collaborating with Gemini means it has more credibility because Gemini itself has been the leader in the industry for very long. But I guess the market wouldn't really believe it until they actually roll out a feature and the market realizing, oh, it is actually working. So that is when that people's story in terms of AI for Apple is going to change. Another question, is Spotify good to buy after news of its raising prices? How's the valuations? So Spotify's position in terms of music streaming is a little bit similar than Netflix position in terms of movie streaming. Because right now they are the clear leader in the music streaming industry. Their closest competitor is it's not even comparable to them in terms of the membership and in terms of the pricing power. So Spotify, just like Netflix, they have been actively increasing their prices, and the market is taking it just fine. You don't see them losing membership just because they raise the prices. So they have very strong pricing power. And Spotify has always been saying that they're using the price increase as something that they're going to push monetization. So this is not something that's surprising when it's come from Spotify. In terms of valuation, right now we have a target price of $650. So that kind of gives you a good idea of where we think it's going. And I think there's another question about Netflix. Yeah. Do you expect the bidding war offer for the acquisition of Warner Brothers will be temporary drag or permanent tailwind on their future earnings? The bidding war itself is not going to take long. Previously, when they came up with their offer, we expect the result to be coming out in around June this year. And now because they're sweetening the deal and they're making it all cash, so they're skipping some of the shareholders' vote. So likely the result is going to come out in April. And right now, Warner Brothers definitely they are favoring Netflix because Netflix offer and Paramount's offer is a little bit different. Netflix is only interested in part of the Warner Brothers. They're interested in specifically its studio and streaming assets. So they include their TV and film studio and their HBO and HBO Max and their DC Entertainment. So part of the legacy, the linear cable network, we're thinking about CNN, TNT, all this Netflix doesn't want. And this actually goes along with what Warner Brothers want to do themselves. They actually want to spin it, their legacy linear TV into a separate company. But Paramount wanted to acquire the entire company. So right now, the Warner Brothers is actually favoring a Netflix side. So in terms of how much of a drag it's going to be on their earnings, in the most recent quarter, they've quoted that they've actually incurred $60 million in terms of acquisition related fees. And in the next quarter, even like be it they succeed or they don't succeed, they're going to incur around $275 million. But with that being said, they're still expecting margin expansion because Netflix right now in their own streaming business, their monetization power is very strong. If you take a look at their revenue versus their PAMI, their revenue growth was about 15%, but their PAMI is able to grow 30% because the cost of making a content available online is somewhat fixed. So be it 2 million people watch it or 200 million people watch it, their cost doesn't really change much. So if the more people actually watch it, every new dollar that comes in pretty much goes straight to their net profit, which is why their margins is very strong. So even with the acquisition cost inside, they're still going to be expecting quite a bit of margin expansion. So I guess for them, it's not really about whether they're able to afford the bidding war. The more question is about whether if they do have the deal, whether they're going to be able to integrate the two very big and messy company together, and whether they're going to be able to achieve synergy between the company. And if they don't, maybe that's going to drag down their earnings. But it's definitely not going to be the bidding war that drags down their earnings. So I hope that answers your question. I guess that's all from my side. I'll pass it to my colleagues. Thanks.
Yeah, thanks, Helena. I'll just take 5 minutes. Yeah, if you have enough fund for 3 counters in construction, what are the 3 counters? Yeah, I think we like based on our buy recommendation and how much upside it currently has, right? I think currently BRC Asia has quite a lot of upside. We like it because there's quite a lot of they have a lot of market share in steel rebar, 60% market share in steel rebar, and BCA last week gave a very positive forecast in terms of construction demand in Singapore. So this will also benefit Pan United, which is another counter, which has 40% market share in ready-mix concrete. And we also like Soy Build. I do think that Soy Build has potential for a re-rating in terms of the construction stocks. Recently, many of the small mid-cap construction contractors have been rallying. So we do think that those are my top 3 counters. Yeah. Why AMD and Intel outperform Nvidia recently? Yeah, I think that's a good question. I think they all have different stories. Intel is mainly a turnaround story. After CEO Tan Lip Bu took over about, I think, second quarter last year. It's about people's expectations and pricing, whether the expectations are priced in. So I think people have a lot of expectation in terms of Intel's growth going forward. That's why their share price has been rallying. For AMD, recently there's a lot of optimism after OpenAI took a deal with it. So this gave it some upside. As for Nvidia itself, because it has been the market leader for many quarters. So recently with the news of Google's TPU coming up last month, I mean last year, November, October, it has been a headwind for Google. People are not, I mean, it has been a headwind for Nvidia. People are not sure whether Nvidia's GPU still holds a place in especially with TPU coming out. But my take is that it does have a place. It is general purpose and their software ecosystem is very strong as well. Yeah, so hopefully that answers your question. How do I derive the target price for Nvidia at $200? Do I price in the China sales? Yeah, so to clarify, currently Nvidia still have a bit of China sales. It makes up about 3 to 5% of their total revenue. So that one is priced into my target price. But I didn't price the H200 portion inside my target price. So if China really approves and if the sale goes through, I do think that there's potential upside for my coverage on Nvidia. Yeah. Do I think there's more leaks to the strong rally on memory storage stocks like Micron and SanDisk? Are they currently overpriced? For Micron, currently a bit more expensive, trading above 2 standard deviation of their historical price to book ratio. However, I do think that there's more leaks to the strong rally. In terms of memory companies inventory wise, usually the boom and bust cycle lasts about 6 to 10 quarters. And it has been declining. The inventory has been declining since first quarter 2024. So I do think that going forward, at least there will still be shortage for 2 more quarters because TSMC has been increasing their capex guidance. Hyperscalers are increasing their capex guidance, and these are big memory companies' customers itself. So I do think that there's more legs to the strong rally on the memory stocks. Yeah. Okay, I'll hand over the time to my other colleagues. Thanks.
Yeah,
Hi.
thanks, Ivan. Tam, you go ahead.
Okay. Thank you, Darren. So let me just take a few minutes to answer some Palantir question. So why Palantir can comment such a high valuation? Are there any other competitors from the Palantir side. So we actually, for Palantir valuation wise, we are looking at the growth potential. So as explained earlier, the total addressable market, if you look at it, the Palantir revenue as in last year is only 2% of the total addressable market of the AI software that they mentioned in 2022 when they went for IPO. So we think there's more potential for them. And then the growing AI software at 25% CAGR, if you think about it, that this AI and software is growing exponentially, and Palantir is only making a small portion. When it comes to market share, I think if we include all the other analytical companies like Microsoft, Oracle, SAP, Google, although the functions are quite different, it's not exactly apple to apple. But if you think about it, Palantir's revenue is just still small compared to these other companies. I think that their market share is only around about small portion, less than 5% of the total market share if you include all the other big names for the analytical companies that provide analytical software, like I mentioned earlier, Microsoft, Oracle. So there's still potential for them to expand their revenue further. And then why we still put buy is because of their AI bootcamp. It's like how they approach, how they do sales, where like the bootcamp is like initiative where they gather the US commercials and governments. Then you as a client could build your software yourself with the raw data that you bring up together. So from this approach, and it has accelerated the sales cycle. Sales cycle is quite short, means like you come to this bootcamp, you build your own software, and then probably in the next 2 quarters, you have a contract with Palantir. So because of this approach as well, we are seeing that their commercial booking is accelerating. I think in the recent quarters, it has been accelerating about 1 time of 2 times when it was previously in the recent quarter. So we think that as more and more commercial companies are adopting these products and widening their industry-wide, so it means more addressable market for Palantir. So that's why we are trying to diversify buy for Palantir. And then for competition, sure, there's competition coming for hyperscalers like Microsoft, Amazon, and Google. We think that why it makes Palantir differentiate is because the visualization approach, that the product is better in terms of visualizing this complex data, but we also see some rising competition from hyperscalers and also large language model, OpenAI and Anthropic, when they also providing similar kind of visualization when it comes to data analytics. But then again, we think still Palantir is still ahead in this industry. So when it comes to regulatory hurdles, there's surely when it comes to government, there's regulatory hurdles that is quite high. But recently they managed to get this called Fed Start and FedRAMP. It means like nowadays they could get a contract with the government side. Now it means like they could provide software for more sensitive data, and could also provide software for the government's cloud, because previously they couldn't, but now they get this authorization for the government to do so. So this has widely increased the addressable market when it comes to government side. And one evidence is that recently in the July last year, they managed to get $10 billion US dollar US Army for the next 5 years. So it's like after they received this FedRAMP start at the beginning of the year of 2025, then it's kind of like a proof that this now the addressable market for Palantir has increased. So yeah, we still that's for Palantir question, I guess. Also I want to Darren for his.
Yeah, thanks, Fahmi. Let me run through some quickly. We'll leave some time for Zain to do the so for First REIT, what's your view on this REIT? Yeah, so First REIT, we expect the full year results basically to be impacted by the depreciating rupiah as usual. So they're just hit by that because their underlying leases are very stable. Yes, base rental escalation of 4.5%, and they're still undergoing the strategic review. So that we have to wait for that to have some updates. But generally, while waiting for that to happen, they are still collecting rents from the 4.5% base rent, which could partially offset the depreciation in the rupiah. But generally, they are impacted by the FX there. So that's for First REIT. ESR we don't cover, but generally we still think that operating performance occupancy around 91%, likely to remain around these levels for the upcoming few quarters in our view, as they try to fill up some of these transitional vacancies. Rent reversion likely to remain around mid-single digit for their properties, but their driver or kicker will likely come from lower interest rates as well. Yeah, land lease, going forward, I think the issue previously was that their ICR was very close to the breach level 1.5 times. So now it's about 1.6. Going forward after the divestment plans, like they divested the GEM office and they also acquired PLQ more 70% stake. So we think the Singapore assets will underpin the growth for land lease. The Sky Complex Building 3 is still like, if I'm not wrong, off the top of my head, like 50% occupied. So that is still a little weakness there as well. Yeah, so that's just a quick view on the three REITs. What's my view on FCT results? Yeah, so the FCT results really surprised that both cinema tenant, cause it was a pre-termination from the Cathay, so that was very quickly backfilled. So both Cathay and Causeway Point space has already been filled. Yeah, so that was a pleasant surprise. And other than that, everything was operating metrics still look very strong. Because of that, also 3.5%. Yeah, generally in line with our expectations. The tenant sales also up about 2%. Yeah. Top three REITs can potentially have capital appreciation. Yeah, for that, our top REIT that we think has the most room for share price appreciation, that will be Prime US REIT, trading at over 60% discount to book, with a lot of portfolio upside as the rents come in, occupancy increases, because now only about 70% of their portfolio is contributing cash, as they have signed some large leases over the past year or so that's yet to contribute cash, as those leases are over 10 years lease term. So as a result, their tenant incentives were like 1 year free rent. So as a result, the rents have not kicked in. But once those kick in and the portfolio continues to increase in occupancy, then over time they'll be more confident to pay more dividends. They've already indicated they'll pay second half dividends at least 50% of their ratio. So yeah, so we think Prime US REIT has the most upside. Other REITs that we think there is potential capital appreciation is Stoneweg REIT, as they continue to possibly very resilient portfolio, and as well as the stake that they have in the 50 million stake that they have in the Ionics, which is a sponsored data center development fund. So that valuation continues to improve, so that will likely have a lot of NAV upside. So as a result, we think share price could re-rate upwards as well. Yeah, so these are some of the picks just off the top of my head. Takraw is breaking out today. Any good news? Yeah, so Takraw, they came out last Friday. They said that they acquire another 80+% stake, so that will increase their stake in the land that they kind of a development in Gurugram. So that's a mixed-use healthcare development. So previously they had a 13.64% stake. They invested about 6 million in that. So now they are going to invest another almost 100 million to acquire another 80+%. So that will bring their stake to 95%. So that was the news. We think for this, there is a lot of upside, because it's a development, and Gurugram is a prime area. So they've, as of latest, they're still in discussion to to finalize the plans for that. So there is possibly, I mean, there will be a hospital, healthcare, possibly some residential, some anchor retail as well. Yeah, so that is still under discussion. But generally, for the value of the land itself, we think there is a lot of upside as the property price at this area will improve. Yeah, so that's the Takraw news. Yeah, what's the view on CDL Hospitality Trust? It looks attractive. Yeah, so CDLHT, we think hospitality this year will be quite challenging, as there's still not many significant MICE events upcoming. Yeah, the strongest year was 2024. So now we think it's a little likely. I mean, for CDHT or rather hospitality in Singapore generally, if they can maintain their RevPAR flat this year, I think it will be a very good performance really. Yeah. Yeah. Okay. Yeah. Due to shortage of time, I'll hand over to Zain to answer some TA. Yeah. Thanks.
Yeah, thanks, Darren. Yeah, I'll take over for the TA questions. Yeah, so first question I see is on iFast. So I think iFast the uptrend is still very steady. Last week, in terms of last week price action was some pullback and then kind of sideways around $10 before another we see bullish price action on Friday with company with increasing volume as well. So I think overall still very strong, and I think it will still likely to trend upwards. Potential target could be eventual target could be somewhere close to 1140. If you take the height of this ascending triangle consolidation that was formed since middle of August. Then next one is on sets. Yeah, for sets, I think overall the uptrend is still in that overall for now a bit sideways, but generally still holding, I think, the 20 SMA level as well as the key level around 380. So as long as it doesn't go below that, I think it should be okay. For now, a bit sideways with some resistance at 390. But could be slowly trending upwards. Yeah, towards a retest of perhaps the previous resistance close to about $4. That was in 2024 October. Yeah, then next question for Oracle. For Oracle overall, I think a bit sideways for now, but yeah, just I think it's around finding some support around 176 this swing low. But I think for it to gain some strength, we need to see it try to break above the highs of the past 3 days. That's around 180 as well as a 5 SMA level. Yeah, then it could potentially do a bit of further rebound towards 186, 187. This next horizontal level is close to the 10 SMA. Yeah, but overall it's still in a bit of a downtrend, and yeah, generally has been finding some key resistance around the 20 SMA for this. So if it breaks below the last week's lows, like 170, then the next potential support to look at perhaps, I think it's around 162, yeah, based on May last year's levels. Okay, then next question is on HST, the Lion OCBC HS Tech ETF. So for this, I think in terms of the price action is looking slightly weak right now because previously after the break of this upward as well as now this downtrend resistance line, I think the breakdown over here at 93 cents coupled with the with price breaking below the 10 SMA that has turned into a resistance last week. So that's showing some that will be the resistance right now. I think 93 cents about there. So for now, the key is to really need to see whether it can hold this 91 cents level here, which has been a support. So it's a bit of a range right now. Yeah, if it breaks below this level, then perhaps we will see some weakness back towards like close to the 88 cent, 89 cent level. So for now, a bit sideways with some weakness. Next one is on MSC, so Malaysia Smelting Corp. So for this, I think overall it's still in an uptrend. Then for this, the volume is a bit low, but I think overall trend has been finding support along the 10 SMA to 20 SMA area. Last week, yeah, did a retest of the horizontal level about 58.5 cents level and doing a bounce upwards. So I think most likely we'll see a retest of the resistance area around 60.5 cents to about 70.5 cents. Then perhaps it will do a bit of a sideways afterwards. Next one is on SIA. Yeah, so for SIA overall, I think it has been nothing much, still quite range bound. I think the key resistance range to break is around 650, and then supports for now is around 640, as well as 635 about it. So relatively still quite sideways, and yeah, I think it will stay like this for now. For Zixing, I think nothing much as well. Also quite relatively sideways. Has been going on since September last year. Key long-term hour support line is still holding support. Should be around 0.02, 0.033 area, which is also currently the range support. I think I think this area will still hold as quite a strong support. And in terms of resistance, likely will still be some of the recent levels 0.036 and the levels upwards at 0.038. Yeah, so I think it should be nothing much and still just range bound for Zixing now. For Yangzijiang Maritime, I think overall for this could be a bit sideways right now. For it to try to reverse upwards, I think we need to see whether it can try to break above this 20 SMA this yellow line, 61.5 cents level. Currently holding some support at 60.5 cents level. Yeah, so if you can hold 60.5 cents over here and then try to break above 61.5 cents, then we could potentially see some rebound back in towards the recent resistance around 64 cents. Yeah. And above that is probably 65.5 cents. Yeah, but for now, I think still sideways and need more confirmation. Yeah. Okay, I think I'll just try to go through two more counters, Palantir and Netflix. So for Palantir, I think currently in terms of the share price, I think we're likely to see a bit of a range bound. So 162 is a horizontal level previously, and then currently the key resistance probably around 10 SMA, that's 173, and then I have this downwards resistance line over there, and then 20 SMA is coming down. So 173 around this area will be a key resistance. And for now, I think support will still be the swing low last week, around 162 about there. Yeah, below that, the next key support probably 149. Yeah, based on previous levels. Then for Netflix, I think the price has kind of reached for Netflix, I think the price has reached the area of support, and then that's around the $82 level. So this was the horizontal support January as well as April last year. And then looking in terms of the longer term trends, it's quite near a long term uptrend support line as well since 2022. So I think for now, in terms of price action, we've seen larger volumes come out after the earnings. Then I think likely we're going to see some sideways movement over here for. Yeah, I think for now resistance could be around $88 about there. The horizontal breakdown level recently, as well as close to the 10 to 20 SMA area. Then that have a this downwards resistance line over here for now. So maybe some sideways over here first. Then if you can recover above 88, then we could potentially see a bit of a reversal. So I think that's it for the TA. I will stop sharing my screen right now. I think there's still quite a lot of questions in the Q&A that we are unable to answer as we try to cut at one. But still, I would like to say on behalf of my team, just like to say thanks for joining in and also for all your questions. Feel free to leave them in our Poems Tree community. Yeah, then we'll try to take it from there. Yeah, so for this week wise, we don't have any corporate insight webinar, but for next week we have Capital Pacific as well as Capital DC REIT. So if you are free, feel free to dial in, and also hope to see you all again in our webinar next week. Yeah. So have a great week ahead. Bye bye.